Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews, and today I'm joined by Bernard Doyle, strategist at JBWere, who has submitted a very interesting submission to the government's savings working group, particularly focused around the stock exchange NZX. Bernard, welcome to interest.co.nz.
Thanks, Gareth.
Look, you've made some very good points, we think, and some of our readers also thought so. You sort of ultimately you're focusing on the fact that we really need to come up with a decision in New Zealand about whether we really want capital markets, and if we do, we need to make some public policy decisions to improve them. And just how bad do you think things are at the moment?
I guess when I thought about doing the paper, it was really, I thought in the context of thinking about savings, it's really important to have a view on are there sufficient vehicles for savings in the economy as part of the solution to improving savings in New Zealand. And obviously, in my background, which has been in the equity market since the mid-90s, I sort of felt I had some perspective to give on whether the equity market was sort of serving its role as providing a vehicle for savings. And when I actually sat down and did the exercise and pulled up some statistics, along with my own anecdotes and knowledge of how things are going here, I think it's clearly not. It's clearly not providing the role a healthy, vibrant equity market would play, both on the business development side of the economy, which is really important, but also on the savings side. And the feedback I would get uniformly from local investors, both small and large, is that the New Zealand equity market is no longer big or diverse or liquid enough to really service their desire to invest domestically. And that says to me we've got a problem. And I guess the second part to the note and the submission was to say, well, if that's where we sit, where do we get to from here? And when you think about how we might get out of this position, it becomes very obvious there's no single solution. And that's where I got to the public policy area, because when you look at what an equity market needs in a small economy to be self-sustaining, and that's the key thing, self-sustaining rather than on the downward trajectory that it is at the moment, to me that's really a public policy decision. The government of the day has to decide we're going to have an equity market, or we'll let it wither away and we'll do something else. And that was really the key message I wanted to get across.
And you seem to be saying in your submission too that if we don't do anything at a public policy level, then it may not be long before we just simply lose our equity market.
Yeah, and I guess we've had some horrendous examples over the past few years of these. In financial markets, you get these spirals. A good healthy financial market or a good healthy economy is a fairly benign feedback loop. But once a financial market or an economy gets into a downward spiral, we've seen it in Greece and Ireland, and we saw it with back in 2008. You can get these situations where they quickly become self-perpetuating. And when I look at the problem our equity market faces, it's one of those spirals, and that is, we've had, over the years, it's just had the odd takeover or lack of new listings, and it's become smaller and smaller and smaller as a role in the economy. As it becomes smaller, it becomes less liquid, it becomes less interesting to investors, so that there are less inflows, less analysts. A new business looking at an IPO path will say, look, the market's too small, and you just get this sort of feedback loop, whereby if you it is the most obvious conclusion from my look at where we sit now is, left alone, it's very hard to reverse this feedback loop, because it's sort of in a now well-grooved downward progression.
So, I mean, in your view, if we do nothing, how soon could we really see it effectively wither away to being completely irrelevant?
That's really hard to have a strong view on. I do think it could be a sort of tipping point type scenario. So one of our top 5 stocks would quickly have a really negative spillover effect.
So a takeover or a shifting to have their primary listing on
shift
another
of domicile
market.
or a takeover of Fletcher Building or Sky City. But, it's a bit of a guessing game.
Yeah.
But I think the bigger point is not so much, it's highly unlikely the market will disappear, but already, well, I'd never say never, but I'd say it's highly unlikely in the near term. But where it's getting to, and where I think it's already at, is it's really ceasing to play the role in the economy that it should be playing. And that's going to continue. And it's going to continue to the point where it's the relevance thing that I think is the important point. It is ceasing to be relevant to the economy. And that therefore leaves a hole for what an equity market normally does in the economy.
Obviously we've got the ASX potential merger with Singapore on the cards at the moment. Could a merger with an overseas exchange be the way to go for New Zealand? Possibly,
and I think one of the issues to be looked at is whether that's the way forward for our market. I'm not, when you look at mergers overseas of stock exchanges, it's really about the quite compelling economics of pulling out costs from an operating perspective, i.e. there's all these synergies that you can have with regional exchanges. So I don't have a real philosophical opposition to that, but it has to be in the context of does it preserve and maintain, and in our case, improve the role that the equity market plays in the economy. I'm not sure if it would or it wouldn't, but if we sort of consider any of those ownership types, it has to be in that context, not we're going to save X $1 million a year in operating costs. That's really not the point anymore.
And look, one of the fascinating figures that you have in your submission is, as a percentage of GDP, our market's now at just 29%, which is sandwiched between Ireland and Greece at 28 and 30%. Obviously, Australia is about, I think it's 119%. Britain, Canada, the US, other countries we traditionally like to compare ourselves with are way, way above us. That's fairly alarming, isn't it, to be down that low?
Yeah, I think that's the cleanest measure of as a share market doing what it should be. And the shame for us is back in the mid-90s, we were pretty close to Australia. The share market to GDP was over 50%, and Australia, I think, was the high 60s. And Australia's gone on and almost doubled, and we've halved. And that is the best indication of how the two paths have diverged. And this is not simply a symptom of they're bigger than us. It's because this is as a share of your economy. We're a small economy, but as a share of a small economy, it's reduced, it's halved. So that's the clearest signal that things aren't going well there. And when I as part of the submission said, well, let's try and find an example of a healthy market at 30% of GDP, and it's quickly obvious to me that you're either, as I call it, God's waiting room. You're either these markets like Greece and Ireland that have had tremendous stress under them, and they're either on the way out or in their own sort of repair job, or the only other markets that tend to fall into this realm are emerging economies that are quickly rising as a share of GDP, and that's the Turkeys or the Indonesias or some of the South American economies. So I guess the point there is it is quite clear to me that, particularly for a small economy at this level of the economy, it's not a self-sustaining level, and it's another indicator that at that size it's not really doing the job it should. Any advanced economy, the share market should be around sort of somewhere between 70 and 130% of GDP. 30% is not sufficient.
And you've made another interesting point in that you've talked about how we perhaps should have and should be more nationalistic. And you've got a good example in there of the John Howard government in Australia blocking the takeover of Woodside Petroleum, whereas in New Zealand we sold off Fletcher Energy around the same time. So, obviously if Fletcher Energy was still around, that would be probably, by your calculations, easily our biggest listed company now.
Yes, the tragedy is Fletcher Energy would be more than twice the size of our biggest company in Fletcher Building. When it was sold in 2001, and it was the same year that the Woodside takeover got knocked back, oil, I think, was $28 a barrel. And at the time, it felt like a good sale, so I'm not blaming anyone really. But what a market like ours need is strategic oversight. And what the Howard government did in Australia, and it's interesting to me that Australia gets plaudits for all sorts of things, but it's not mentioned much. There's sort of quite obvious self-interest when they look at transactions like this. And so that is a really interesting comparison because they both happened in the same year. And the Howard government was very widely criticised for knocking back that transaction by international investors. Australia was panned, and some of the things we worry about as a country, you saw going on there saying, we'll never invest in you again. But the reality is someone in a market like ours has to take a 20, 30, 50-year view. And so Fletcher Energy is the obvious example of that, but there's others in the forestry sector as well. So I think in New Zealand, one way or other, we're really lacking that long-term investor because portfolio investors will always be lured by, a 50% near-term gain. And unless you've got a counterweight to, big international trade buyers, whatever new supply comes onto our market, chances are we'll probably lose it without some sort of strategic element in our either in our public policy or having someone like the super fund as a strategic investor. So that's sort of one of the areas I thought was an interesting conclusion, because we can talk about improving demand and improving supply, but to keep the supply in the market is also a bit of a challenge in our market, and I've seen that through the past 15 years in real time.
Yeah, okay. We've run through some of the problems now. So what are the solutions? We need a much more proactive government. Is that one of your arguments?
Yeah. Well, where I feel the government absolutely needs to step in one way or other is we need a more explicit statement of intent, and it's funny when you look at financial markets because confidence is critical, and there's a whole lot of unintended spillovers when there's a lot of sort of pebble in the pond type dynamics in financial markets. And so what I think we need as a starting point is a government that says we've decided we're going to have a capital market. It is as clear as that to me. More than the how, it's the are or aren't we. And from there, it has to come at that level, to me, at the public policy level, because it is a public policy decision. It's a real cornerstone strategic asset. So we need a message from the government that, yes or no, we are or we aren't we intend to maintain and have a healthy capital market. If we aren't, we need to know Plan B, because Plan B is how we're going to nurture and grow a whole lot of businesses that the capital market's job is to nurture and grow. And so that's the very top level point from me. And then a whole lot of other sort of public policy questions come from that. One is, how do we treat overseas investment? One is, is there a role for a super fund as playing a cornerstone investor role in helping keeping supply and strategic assets such as airports and ports in the market for the long term?
And that probably would require the government to start providing money to the super fund again. Yes,
and I think when I was thinking about what could work, because I understand the fiscal constraints the government's under, we've got the situation where the government's sitting on a lot of really high quality assets, but they're quite narrowly focused. Most of the SOEs, well, a lot of the SOEs that could easily be in the listed sector, in the energy space, in the electricity and generation space. And so, if I'm the government saying I've got a quite strategic holding on my balance sheet, but it's quite narrowly focused, there's a bunch of other strategic assets in the share market that I have no holding in. Why don't I use some of the SOE funds, A, to provide supply to the equity market, and B, from the proceeds of that, I could recycle them into a very broad cornerstone holdings in a number of important assets. And I sort of think that's a two birds with one stone type solution, in that you're having zero impact on your net worth. You're not putting any more drag on your fiscal position, and you're really helping the capital market by providing supply, but also protecting an existing pool of assets. And whether it's a super fund or someone else, it probably makes sense to have a conduit as a holding vehicle for some of those stakes, and the super fund was the natural one from my perspective. But none of what I've suggested in a policy sense I am necessarily saying is the only way or a magic solution. But to me, it has to focus on those dual problems of releasing more supply, and the government is a obvious owner of a large tranche of supply, and B, protecting the supply for long-term investors.
You've also raised an interesting point of the possibility of a discounted offer to Kiwisaver account holders of SOE sell downs, which obviously that would bring in more local investors as well, which I assume we want to do, given we've had the post the 87 share market crash, we've had the finance company debacle now, so we want to encourage Kiwis to invest in quality investments as well. So perhaps that's a way of doing that.
Yeah, I guess I'm doing a bit of kite flying with some of this thinking, because I think it's very easy to just slip into an orthodox, what's the sensible market-led solution. The sensible market-led solution in New Zealand is probably for us not to have a capital market, and our starting point, my starting point, is that's not a very good one. And so the idea of somehow integrating Kiwisaver into an appetite for owning high quality strategic assets, I thought kind of could be good. And I think it also, we've got this 20-year-old bugbear with privatisation, and in many cases rightly so. I think the way privatisations were done in the past weren't good for our country, or certainly domestic investors missed out on a lot. So whatever the government does with their assets in the future somehow has to loop in mum and dad investors, and I just think Kiwisaver is probably a great way of ensuring those investments are of a long-term nature, which is exactly as they should be. By the way, though, I'm also quite cautious of meddling with diversification and asset allocation. So nothing of what I suggest, and no solution should really be around the idea that we are forcing or coercing people into narrowing their investments into a New Zealand-centric portfolio. But there is plenty of scope to have a good exposure to New Zealand and a broad, globally diversified investment portfolio.
And one of the other points you make is, again looking at Australia, they've got their 4 pillars policy with their big banks. Obviously, our 4 big banks are all Australian owned. You've raised the idea of one of those floating would be a massive boost to the NZX, which undoubtedly it would be, but it's probably not too likely in the short term.
Well, to me, that's another thing that won't happen of its own accord, because that would be the sort of the baby python swallowing an antelope sort of thing. It would just be too big for the equity market to handle on its own, without some sort of support. And also that something like that would be a huge and complex transaction. So it probably would require regulatory assistance, as well as possibly some sort of cornerstone stake to kick things along. But all that aside, I think again this is just something. Do we want to do it or not? Do we want a capital market or not? Because it's, when you look at New Zealand, and when I look at the path of the share market and the unlisted market, or the unlisted economy over the last 15 years, really just all you've seen is the share market as a share of the economy shrink and the unlisted sector expand. And so that's really all it's about. How are we going to get some of these very big companies from the unlisted sector back into the listed sector? And in many cases, it's not just an obvious solution, because the unlisted sector has very big companies, and the banks are obvious examples of that. The oil companies are also examples of that. And it's an interesting sort of transaction in the past year has been the super fund JV on Greenstone. That's the sort of thing that has to happen these days, because the idea of the Shell stations just being floated clearly probably didn't get traction, and it needs some sort of creative solution. And the banks even more so, because they're very big businesses. The flip side is it would be a fantastic asset to have in the share market, as a new sector. We don't really have a financial sector.
Look, have you had much feedback on your submission? And I mean, obviously the Savings Working Group has been given pretty narrow terms of reference by the government. Bill English ruled out several things before they even held their first meeting. So, I mean, have you had much feedback, and how hopeful are you that some good will come out of this process?
Yeah, I've had a lot of feedback, and by and large, touch wood, it's been pretty positive. Not, certainly I think the most debatable aspect of my submission is the conclusions, and it's really the conclusions, the policy recommendations that I'm most open-minded about, because I don't pretend to have all the answers. I guess where I can contribute to the debate is say, from someone who's been in the market for a long time. I'm a strategist, I was an economist. I hopefully have a perspective of where things are heading and where we sit right now, and the role in the economy. So, most of the feedback has been, well, that's pretty much bang on, the assessment of where we sit and where we're heading on a sort of unassisted trajectory. I suspect on the policy recommendations, the most controversial around compulsion or government intervention, and I think that's fair enough. That's where you have to be most careful. But I think the upshot for anyone that's thinking about this debate is it quickly becomes obvious that some sort of public policy input is an absolute necessity.
Okay, well, it's Bernard Doyle, strategist at JBWere. Thanks for coming into interest.co.nz. And I'm Gareth Vaughan with another Double Shot interview.